So you've spent years, maybe even decades, building wealth with your investment property, and it's paid off. But what if you're just done? Ready to hang up that landlord hat for good, but you don't want to hand over a massive chunk of your hard-earned profit to the taxman? Well, stick around because we're going to break down a strategy that lets you do exactly that. I mean, this quote really says it all, doesn't it? If you're a landlord, you know exactly what this means. The terrible tease. This isn't just about money. It's about the everyday grind, the stuff that really wears you down over time.
And there it is. That's the big roadblock. You're sitting on a pile of equity, which is fantastic. That was the whole point. But then you think about selling, and you picture that massive capital gains tax bill. It's enough to make you just stop in your tracks. It feels paralyzing, and it's the exact dilemma so many property owners find themselves in.
So this is what we're talking about when we say the landlord's dilemma. You feel caught, right? Trapped between the day-to-day stress of actually managing the property and the huge tax hit you know is coming if you decide to sell. I bet this list looks pretty familiar, doesn't it? The late-night calls about a leak, the constant merry-go-round of finding new tenants, screening them, and just hoping they work out, juggling repairs, handling complaints. It's basically a second job. And you know, for a lot of people, there comes a point where the stress just isn't worth the paycheck anymore. All right, so how do you get around the tax part of this dilemma? Let's start with a classic tool that most real estate investors have at least heard of, the 1031 exchange. So what is it really? At its heart, a 1031 exchange is a way to hit the pause button on paying capital gains tax. Instead of selling and writing a massive check to the government, you get to roll 100% of that money into another, similar investment property. It's all about keeping your capital working for you. Okay, but here's the catch, and it's a big one. The timeline is, well, it's brutal. The second you sell your property, a timer starts ticking. You have just 45 days to officially identify a new property. And you have to close the deal on that new place within 180 days total. And these aren't friendly suggestions, folks. This is the IRS. These deadlines are set in stone. And that brings up the real question, doesn't it? The 1031 is great, but it means you have to buy another property to manage. What if the whole reason you're selling is to get away from being a landlord in the first place? What if you just want out of the game? Well, this is where a really smart, almost elegant solution comes into play. It's called the Delaware Statutory Trust, or DST for short. And this, my friends, is the game changer. It qualifies for that 1031 exchange, so you defer the taxes, but, and this is the key, it does not require you to be a hands-on landlord ever again. Just look at the difference here. It's night and day. On one side, you have the traditional landlord life, direct management, tenant headaches, surprise repairs, all your risk tied up in one building. On the other side, you become a passive DST investor. You trade all those duties for no duties. You get predictable income, and your investment is spread across multiple properties managed by professionals. It's a total shift from active work to truly passive income. So let's break down why this is so powerful. First, and this is the big one, you completely wipe out all your landlord duties. Gone. Second, you start getting predictable monthly income, almost like a paycheck from your investment. You also get to diversify your money across a whole portfolio of high-quality properties. And you're doing all this while keeping 100% of your money invested and deferring those taxes. Okay, so that's the theory. But let's see how this actually works for a real person. We've got a great case study here about a landlord named Michael. Michael's story is probably going to sound really familiar to a lot of you. He owned a small apartment building for more than 20 years. He'd done well, built up a lot of equity, but he was just ready to retire. And the one thing holding him back was the fear of that giant tax bill that would take a huge bite out of his retirement fund. So what did Michael do? He used a 1031 exchange to sell his building and roll every penny into a portfolio of these DSTs. So what was his final capital gains tax bill? The answer is right there, a big fat zero. He paid absolutely nothing in capital gains, keeping his entire nest egg intact and working for him. And look at the before and after of his actual life. It's just dramatic. Those late night calls, poof, gone. His income stream went from being all over the place to a steady, predictable deposit every month.
He had so much more free time and peace of mind that he actually went traveling for 2 months without a single worry about his properties. He didn't just defer his taxes, he totally transformed his lifestyle. When you really boil it down, this whole strategy isn't just about numbers on a spreadsheet. It's more personal than that. It's about taking the wealth that you've worked so hard to build and finally cashing it in for actual, real-life freedom.
So let's just recap the strategy one more time. It's simple, really. You get to exit the landlord role for good. You get to keep that income stream that you've come to rely on, and you get to legally defer your taxes, potentially forever. It's the best of all worlds.
So I'll leave you with this one last question to think about. For years, maybe decades, your property has been your engine for building wealth. That part's done. The real question now is, how are you going to let that very same asset become the key that finally unlocks your freedom?